So thank you, everybody. And this is going to be good. And I tell you why I like this, or we like this, Pete and I like this. It's completed. And we're going to go into the details, obviously. It's completed and rented. And as I was speaking to one of our colleagues this week, Paul, he likes that because clients can know exactly what they're going to get, what exactly it's going to cost them, and there'll be no surprises or voids. So we're pleased with that. Lauren, tell us all about Excelsior Works.
Yeah, thanks, Chris. Yeah, I think that's one of the key points, isn't it? Like, a lot has changed in the last 6 months. We had a good 10-year run, and a lot's changed in the last 6 months. I think there's a lot of there's a lot of trepidation out there. Sorry, my slides aren't changing, Chris.
Sorry?
Oh, there we go. Okay. I want to just talk a little bit about the serious stuff before we get into the really, really exciting stuff, which is the project. So there is a lot of uncertainty out there. There's high inflation, there's effectively higher interest rates. The only people we're seeing that are buying in any kind of numbers are investors, because naturally when there is some type of downturn or uncertainty, investors will see that as opportunity when sort of, other buyers remove themselves from the market. So what we've got effectively is a base rate of 3.5%. And that means domestic mortgages. The best domestic mortgage you're going to get as a buy-to-let investor is around 4.5% at the moment. And then for overseas buys, you're looking at around 5.5%. So that is a good 1.5% higher than we were several months ago. So it's not a huge amount, but it is significant in terms of people's cash flows. The Bank of England's view is that we'll peak at around 4.25% in the middle of June 2023. And then it will come off, and then we'll start to see some recovery in 2025. But if you look at the forecast from Oxford Economics in terms of where base rates are likely to be, if you look at 2027, in 5 years' time, we're still looking at a base rate of 1.75%, which means sort of gone are the days where we had almost free money. We had the GFC, and then we had really, really low base rates, so 0.25, 0.5% interest rates. So really, really nice and an easy time for investors at that point, and for the wider market. But that, we have new normals now, and there's a huge amount of opportunity out there going forward. What we do know is that property is still the safest asset class. So if you look at the last 100 years of different asset classes, you will always find that property comes out on top. There is a saying that it's not timing the market, it's time in the market. So if you have a property for 5 years, 10 years, 20 years, you're going to make money regardless of where you buy in that cycle. But what I've been trying to do is concentrate on completed stock, because I think there is an element of being able to also time your entry point correctly as well. So what you need to think about is controlling what you can control in this sort of uncertain world at the moment. So that means buying in safe locations. And what I mean by that is buying in locations which are underpinned by serious supply-demand imbalances. So you're going to ensure you have that sustainable capital growth. You want to buy at the right price. So we know that there's a downturn. We know that there's going to be a slight correction. It's not going to be massive by any means, but there is going to be some sort of correction. So we want to be buying at the right price. And obviously entering the market at the currency rate now, as opposed to, if you buy an off-plan property, you don't know what the currency rate is going to be, or when that developer is going to call in your completion in 2 years, 3 years' time, and what happens between now and then, sort of world events and what happens with interest rates. So all of these factors mean that there is some element of being able to control your investment at this point in time as well. So the project that we have in Excelsior Works, it's in a great city called Manchester. Manchester is the second most researched residential city in the UK after London. So investors have, for as long as people have been investing in the UK after London, Manchester seemed to become that sort of second hub, followed by Birmingham and Liverpool. But Manchester's always been up there in terms of popularity. It's got double the average UK population growth. So that's really, really important. It's swelling. This population is really, really booming, and it's putting this pressure on both rental and capital growth in terms of pricing. In the last year alone, we've seen 20.5% year-on-year rental house price growth, which is just extraordinary for one city, and it was one of the highest in the whole of the UK. It's got extremely strong economic growth forecast over the next 5 years. In fact, it's the #1 city for forecast economic growth. Obviously, I mentioned the housing imbalance, the major issues that they have in the city there. It's the largest regional city outside of London, and really, really important and key. These latest figures that have come out from JLL put Manchester as #1 for capital and rental growth for 5-year forecasts, which has never really happened for actually before, to have the same city at #1 in terms of forecast. So we're looking at a really positive city here for this investment.
And Lauren, just to give you a break, I mean, extraordinary amount of change in a city of Manchester. You know, in the last 30 years, it's just an extraordinary growth, gentrification. The whole thing is now a beautiful city with obviously 2 wonderful football clubs, if you know what I mean. But I mean, it really has changed a lot, and same true obviously is Birmingham as well. You know, we've got to take advantage of that, and I think that's what we at Holborn are always trying to do. We do not want people having a void period, and therefore, as you say, the supply demand imbalance is so important for our clients.
Yeah, exactly. And I think that's why due diligence is really, really important, to make sure that your clients are buying into the right cities to sort of safeguard that investment. And I know that that's what you guys do very, very well. So the economy is a very, very strong economy, the fastest rate of growth over the next 5 years, according to Oxford Economics. Employment is extraordinary. The unemployment rate is very, very low at 2.5% against the UK average, which is going up from 3.5 to 4%. You've got something like 1,300 new businesses opening up in the city every year, which means there's going to be a lot of depth to that economy. So people have got confidence in what they're doing in that city, lots of inward investment. And obviously, as you can see on some of the logos there, some really, really big companies have made their homes and their offices in Manchester, which happens with any sort of large regional city if it's correctly placed. Employment, as I mentioned before, also really, really key to growing a city. It's one of the reasons people are attracted to big cities. You know, this job creation. So in the city of Manchester, you have a lot of high-rise residential towers, but you've also got these commercial structures and cranes everywhere. And a lot of these are new businesses that are ready to be let. So the funders and the developers who put the money into those towers, they've got confidence in the economy and who's actually going to let those units going forward, with the 25% of them are actually pre-let. Education, so it's got the most international students in the UK, in any city in the UK, so 100,000 students. And you have a 60% graduate retention rate, which is really, really important. And that obviously helps to grow that population, to add demand to the property market as well, and obviously the economy. So what you want to see in these types of cities is infrastructure. So when you see a swelling population, you see lots of people moving to cities, you want to make sure the infrastructure is there to actually support that population growth. And it really is there in Manchester. So there's a big expansion happening at the airport, which links obviously 255 global destinations. You've also got HS2 coming, so it's coming in 2029, and it's definitely not a reason why people buy in Manchester or in another city because of a link, but for investment purposes, to actually link up the north and the south, that's going to be a really, really big boost for the Northern Powerhouse and for the economy. So you remember, Chris, what happened with the Crossrail line in London, in the Elizabeth line?
Absolutely, yeah. The Elizabeth line, which it is now. Yeah, and I had a go on it as well when I was in London.
Did you?
Very
yeah,
posh. It's very nice. It's expensive, but it's nice.
It's
and
nice.
The same,
yeah.
You know, when the HS2 opens up, it's going to, you know, all those people along that line are going to get an increase in the value of their property, and that's the most important thing. But
Yeah,
also, you've got that slide at the top there. That is a lot of money. I mean, 1 billion expansion plans just for the airport. So they must be so confident of the growth of the city. Again, sorry, I interrupted.
And I think the jobs are important. The jobs that are brought into cities from these, these infrastructure businesses, and obviously the metro, is connected 93 stops across 7 lines in the city. Looking after 40 million journeys per year. So all of these things are, contributing to the city. This is where it gets really interesting. So this is where we back up the the data and the figures and the conversations surrounding supply and demand imbalances. So when this slide was done and when these numbers were forecast was in 2020, when we just had obviously a pandemic arrive on our shores, and they were forecasting the distribution and the difference in terms of supply and demand up to 2031. So the required units at that point in time were 6,500, and the completions were 5,500. So around about 1,000 in terms of deficit every year. But what that didn't take into account was a backlog of 66%, a huge backlog of around 38,000 units, which were already undersupplied into the market. So it was crying out for more product. And now what we have is unfortunately is another downturn, which means there's going to be less supply into the market. And I'll show you that on the next slide, meaning we're going to just compound this problem. So this distribution is only going to get wider. And what we saw, obviously, because of this massive imbalance between March 2020 and November 2022, a 23.7% growth just in the center of the city in terms of one and two bedroom flats. So quite interesting. Now, this is about startups. So you see the economic cycles here in the downturns, recessions, and it's about the number of new build startups. So you can see they fall basically, and construction actually hit a low point after the financial crisis in 2008. The forecast is that new house starts could nosedive 40% in 2023. So that's only going to compound further an already, very, very problematic situation. That's why they really call it a housing crisis. It's not just in Manchester. I mean, the UK suffers a housing crisis continually, but there are certain locations such as Manchester where people want to be and that population is growing, where it's only going to get worse. And obviously for investment purposes, that's very good. So these are the house price forecasts from JLL, and they only came out in the later half of December, which means they are the latest that have come out from a big house, investment house. So what we have here are the regional forecasts. So as you can see, the Northwest, which is where we're situated, is looking at around about a contraction of 7% over the course of 2023. So not a huge amount when you think about Manchester having grown just in the first 11 months of last year, 11.5%. We're looking in 1 year, and the only year that you're looking at a contraction according to these forecasts is next year. Whole region -7%. If we look at the city centres, and obviously this is the centre of that region, Manchester's actually looking at some positive growth. Now, it's not a huge amount of growth. If we're looking at 11.5% last year, next year we're looking at 1.5%. So it's slowed right down, but it's still growing. And that's because obviously of these major imbalances, and the indexes that these companies come up with are very, very vast. They know what they're doing. It's not a finger in the air job.
It's worth mentioning that JLL and Savills and Knight Frank are the leaders, for the people on here, and especially clients. That's where we usually get these figures from. As Lauren said, it's not a finger in there.
Yeah, I think if people think that the world's going to come to an end in property, they're completely wrong. And it's really interesting. All of the very sensible reports. I heard you mention JLL and Savills. They're still saying that we're going to be quite robust. There'll be a slight softening this year, but that's already been factored into a lot of the prices that we're giving anyway. So if you take any medium-term average, it's always healthy. What we've got is a situation where if you take a medium-term average, you'd expect to see 3.5–4% capital growth a year. Last year, even the poor areas in the UK were seeing 10 to 12% growth. And in actual fact, some areas, such as Nottingham, were seeing 22, 23% growth. So you can't expect that to carry on. So there's a realignment. That's all that's happened. And in actual fact, with the yields, the most important thing for investors is that yields are continuing to grow. And I've got a little apartment block there in Southampton. There's 102 apartments, and we've seen 14% growth on yields over the last 18 months, and that's still continuing. every time a void comes up, we're managing to put another 50, 75 pound an apartment on each month and getting it. So I think it's really important for people to understand that pound cost averaging is the friend when you're involved in property investment. Don't try second guessing a market. You won't be able to do it. None of us can.
The other one to mention was Lauren's on and you're on. The reports are on BBC, LBC, and in the Daily Mail, of course, which is read by everybody. York #1, and we've had a project before in York. So our clients are delighted with that, and we've actually still got one up in York as well. That's just a bit of an advert for me. Okay, thank you, Lauren.
Yes, moving on to actually the rental house. Where are my rental house price forecasts? This is about rental house price, and actually Pete just touched on it. And obviously when we see a downturn in any kind of sales market, if it's a small or a large one, people still need to live somewhere, right? So you've got a city with a rapidly growing population. More people are forced to stay in rental because those first-time buyers can't get on the property ladder, or people can't move because of interest rates. And you've got a huge graduate retention. So all these factors adding to that, to that issue. As I mentioned before, we had 20.5%. This was the figure to October, but at the year ended 20.5% year-on-year returns. The area where our project is South Central, and this is for 1 and 2 bedroom flats, and you can see pretty much every area in the city other than sort of East Central and Piccadilly is going up sort of almost exponentially. So really, really good for the city centre locations.
I think Manchester's seen a real spike over the last 2 or 3 years. But if you look at the medium-term growth potential for Manchester, and in particular the most important thing is good employment in Manchester. A lot of the very large companies are going there, so therefore that grows the yields in terms of revenue, but it also underpins it in terms of sentiment and somewhere you should invest. That's also very important.
Yeah, exactly. So these rental growth forecasts, I actually think they're probably quite light given sort of what's forecast in the next year or two. But as we can see there, Manchester is also leading the way, and with some strong figures, 21.6%. So not only are we looking at some strong capital growth, which is going to be quite important in the next 5 years, these rental growth figures and these yields are going to be really great as well. So I just wanted to put this nice, colourful, pretty slide on because it pleases me. Castlefield is the area that we've got the project in, and it's a different area. So a lot of people think Manchester is high-rise, shiny buildings, and it's all very commercial, which it is. But there's a real interesting dichotomy. You've got centrally located Deansgate, Castlefield in the same tram stop, but Castlefield is a very, very different feeling. It's warehouse bars and restaurants. You've got some really nice warehouse conversions into residential and some into commercial, which gives it a really, really nice feeling. You can walk up and down the canals and get to a central location very, very easily.
Lauren, I'm just going to interrupt just quickly because Kieran watches these shows every week. Thank you, Kieran. And she's just pointed out that on that one of those first slides you did there, you called people non-dom rather than non-domicile, rather than expats. So just to make that clear, we were talking about residential rates for people in the UK, which I think you had there at about 4.5%, and then more like 5.5% for people that are working abroad. Investors. Yeah, just making that clear. Sorry, carry on.
Okay, so the project that we have is called Excelsior Works. It's on the Bridgewater Canal. So canal side living, 10 minutes walk into Deansgate. It's 108 apartments. And it's got all the things that you want as a city centre development. So it's got concierge, communal workspaces, it's got a roof garden, and then obviously the hyper optic is another add-on. But this particular development completed in March 2020. And what else landed on our shores in March 2020? We had a pandemic. So the developer was only able to complete on half of the units. And what they were able to do was just to rent the other half. They could see that the pandemic wasn't going away anytime soon. They were unable to do viewings. It was very, very difficult to deal with a completing development at that time. So they thought, we'll just rent these units and then we'll sell them at a later date. So what we've got now is we have 30 tenanted units. within the development. So the developer has still got control of those units, and they would like to sell them now. So it started with a 10-year build warranty. So we have 7.5 in March. It'll be 7 years left on that build warranty. So nice and strong NHBC. Obviously, they're all tenanted, so you've got immediate income. We've got gross yields up to 5.5%. Mortgages for UK buyers will be up to 75% on some of the units. It's all based on stress tests and the income. So the income levels are very, very strong, and the prices are low. So you're going to reach those levels quite easily. And they've got some really nice starting prices there.
I mean, I did mention it right at the beginning of the show, and it is a show, that these are already tenanted. A question's just come in. If it's already tenanted and the rent's agreed, when and how may they increase those rents? Is it an annual thing? How does that work with them?
Yeah, so I've got the schedule when all the tenancies, the start and the end dates, and when we are 2 months before the end date, the managing agents will negotiate with the current tenants to increase the rents, and pretty much everybody accepts that, because nobody really wants to try and move in Manchester because it's an absolute nightmare to try and find accommodation. There was a Channel 4 program on in the end of November last year, and I think one of your wealth managers posted it on LinkedIn, I saw. It was about the housing, you know, the rental crisis in Manchester. The agents were saying it used to be 2 or 3 people per property, and now it's 20 to 30 people per property. So they're not even doing viewings now. They take a video and people put down the deposit straight away. So if you've got a tenant in there, they will very, very likely accept the rental increase. That's just unfortunately for the tenants in Manchester, that's the way it is. But for investors, it's obviously positive.
And this is so positive, given the conversation I had with Paul Barras earlier this week. This is what he loves. He loves the idea, that's the purchase price, that's the rent that's coming in, that's the illegal cost, that's your mortgage, and it's a done deal. And that really does appeal to a lot of people. And hopefully people maybe even thinking about buying more than one. I mean, there are 30, did you say 32, 34?
Well, we had 35, we've got 30 now. 30.
Right. Okay.
Yeah.
All right. Yeah. So
30 of them.
Anyway. So I think Peter was going to speak. Peter, did you?
Yeah, I was just going to say I can back up Lauren on this. Down in our Southampton scheme, we had a void come up 3 weeks ago. The guy just decided to leave. Luckily, he left the apartment in great order, but said, "Look, I'm going to go." We put it on our social media site that we use. We had 33 people want it inside 4 hours. People just basically texting and saying, "Look, give us a bank of details. I'll transfer the deposit." It's mad. It's mad out there. There's very little stock for people to move into in any of the major cities, and that's going to continue and grow.
Yes. Yeah. Exactly. So it is.
Just give a really. I've done this before, but it's to me really important. We've got 750,000 houses short of a picnic in this country already. And then the government want us to build 300,000 new properties a year. We only built 160,000 last year. We've then had a net gain of migration into the country of 326,000 people. We then had 106,000 people more born in this country than died last year. So if you look at the compression of all of those numbers of everybody wanting stock and property, it's colossal. There's no way that we can carry on building and keep up with that, by the way. So, you know, on yields, it's going to be a really good market, not just for the next year, but for the next 5, 6, 7 years, because people aren't going to start living in tents.
Yeah, and I think that's the thing with buying property that's fully completed. You're not looking at any void period anyway. So you're not competing with 200 or 300 other people and looking for tenants at the same time.
We've de-risked it completely, Lauren, haven't you? The fact is it's there, it's physical, and you're going to have rent roll from day one. So I do think that one of the reasons I was quite excited about this project is that, you know, you've got something that's totally tangible. There is no risk to it.
Mm-hmm. Yeah, exactly. So the building itself was an old bookbinding factory on the Bridgewater Canal. In the foreground, if you were to walk along the canal here, you'd come into the Manchester city centre. And if you walk the other way, you get to Media City. So it's nicely placed on the canal between two very, very large employment hubs. So really, really good location there. It's obviously completed, so we have the ability to show you what it looks like right now. Got some pictures of the concierge area, some pictures from outside, and then the rooftop terrace. And then these are some of the internals. So they're all relatively new. They're only two years old. like I say, 2.5 years old. In March, they'll be 3 years old, but they're all in very, very good condition.
And presumably paying a little bit more for those water-facing ones, Lauren?
Well, yes, you do.
What
And that's
would the view be at the back?
The interesting thing is the canal-facing units. It's nice to have a canal-facing unit, but they yield less because you pay a little bit more for the canal. So if you're an investor, it almost makes sense to buy something that's, you know, you've got to think about sort of a business decision. So you can buy either. We have both. We have canal facing units. We've got south, east and west facing units. Anywhere in the development is going to have a very, very good capital appreciation. If you can see on this map exactly where we are, Castlefield's here. Deansgate Castlefield station is right here, and you can see this sort of change in scenery. So it's very commercial down Deansgate, which runs along here to Spinfields, and then literally around these locks here, Merchant Bridge, it's all warehouses and beautiful conversions. And what we are is right in the middle. So the tram stop Cornbrook is here, goes all the way to Media City, Old Trafford down here, and then the city centre. So really, really well placed. 10 minutes walk into Deansgate.
And the central business district, I'm right in thinking that, yeah, there. So two stops.
Here. Yeah, exactly. So a lot of people are working in Deansgate as well. So
yeah.
If you work in Deansgate, and you just walk along that, but yeah, it's only 1 or 2 stops. So this is where we talk about getting the price right. So this is part of my price list. And what the interesting thing is that we want to look at is the pounds per square foot, which is a really good place to start. And when we have valuers valuing property, they will look at different aspects and things like that. But pounds per square foot is a very good place to start. And what we are selling these units for is around a blended average of around 409, 410 pounds per square foot. And your effective yields are in this column. What we have is some very, very recent comparables. So when valuers go in for lending purposes to look at the project and say, what is the value of this project? They look at what's happened in the last 6 months. And what we have is at the end of September, all of these completions at around 450 pounds per square foot. That's a blended average. So we are something like 40 pounds per square foot off what our comparables are. So we've more than factored in any kind of softening of our market or anything like that, because what we want to do is we want to get these units away quickly for the vendor. So what we've done is we've reduced the price to increase the yield, because obviously it's investors that are buying right now, it's not end users. If we were targeting end users, we'd be increasing the prices. Yields are not as important, but we know for investment purposes what's attractive. So this is all very, very positive.
210,000 for Manchester for a 1-bed is blooming good.
Yeah.
It is blooming good. And 275, yeah. And I can't actually look at all the figures, but quite a few units at that end at 210, or only a few?
Yeah, no, there's 5 1-beds, and then the rest are 2-beds. But we've got some of the smaller 2-beds, really, really good investments as well. But it depends. You've got great yield. It depends on people's equity and what they can put into a project. If you can afford to put a bit more in, why wouldn't you? Because you're going to have the sort of the relative returns. Now, when it comes
on the previous slide, you said 70% mortgages. Yeah,
so actually I'll go back just to show you. So this is a stress test. So we've actually, when you've got a completed product, you can actually do a stress test and run the figures with a mortgage broker, and they can tell you exactly what you can get. So on that top unit, for example, you can get a 76.3% loan to value because of its income. So it just depends, what the income is at the time. If by the time somebody purchases a product, one of the units, and we've increased the rent by then the stress test will give you a little bit more in terms of loan available.
Okay, good.
Okay, and this is some comparables, which it's really important to have the comparables, because it's good for our purposes to be able to say to investors, yes, this is what the value is. But you also need to be able to justify it to your surveyor. And that's why buying completed product in this market is really, really good, because you're not going to be overpaying, because the lender will never give you a mortgage if they feel like that the value is not there either.
Lauren, just to interrupt you again, sorry, it's Kieran again. And if I don't mention Kieran a couple of times, then I apologise. She's me again. I know the area really well. It's close to the centre. There are a number of restaurants and bars in Castlefield. It's genuinely a nice area with a good vibe. There we are.
Thank you,
Kieran.
whoever that was.
Kieran.
it's very well placed. It's, you know, number one is our development. You've got a couple of very, very newly completed St George's and City Gardens by de Trafford. Literally, I can see it. I can throw a stone at it. So we've got direct comparables in this market. And what you can see is the pounds per square foot. So this is really, really important. So if our development is blending at 409 or 410 per square foot, and all these other developments are much higher, it obviously boasts, it means that we're actually getting this for a very good price. So down here at Trafford, number 11, this is a Cold Waterhouse development. These are selling for around £450 per square foot, much further away from the city. Number 10, over in Media City, it's called High Definition. These are 421 to 426 foot, and that's about 2 miles away from the centre. So, and then obviously Vision is one of these tall, shiny skyscrapers in Manchester, which is, you know, is very, very expensive and lovely. But it's around £620 per square foot. But that is literally next door. Sorry, I'm getting ahead of myself. So what we're just trying to demonstrate here is that the value is very, very good, and we're getting these for a very, very good price at this point in time. So this is a very easy building. It's 7 stories. So you've got the 2 bedrooms around the outside of the building, and the 1 bedroom space south here. You've got the canal on the front side here. To the right, you've got views of Deansgate, and to the west, you've got Media City. So it's a really nice, simple building to sell. Obviously, a lot of people on this call are going to be investors and wealth managers, and these numbers are going to be very, very important. So I've done an illustration of what the returns look like for a sample unit. So this isn't even one of the highest yielding units, but I just liked the fact that it was a 2-bedroom unit, and it was one of the smaller 2-bedroom units, which are often quite popular. So 283,000, and these are based on the JLL forecast. So what we've done is we've fixed in rental growth forecasts, we've fixed in the capital value forecasts, and obviously you have those accumulation figures. So you can see people's return after the mortgages and after the outgoings every month. So in the first year for that particular unit, it's £155 in terms of net cash flow. Yes, it's a bit of pocket money, but it's also the capital growth, which is going to be really, really key here. So on a 70% loan to value, which is these are the figures based on an overseas investor, because the 5.49% is where you're going to be for an overseas investor or expat. Done it again. These are the figures here. So if you have an equity of around £104,000 for this particular unit, your net cash flows over those 5 years are around 15,000. And the capital growth is around 54. So nearly £70,000 in returns. And those are net returns over that period. So cash on cash from your initial investment, 67%, or average annual 13.3%. So not to be snuffed at. What do you think, Chris?
Very good figures.
And obviously on the right-hand side, there's a couple of units. Some overseas investors will get 75%, but there's only a few units that have that availability, but it just gives some example. If we've got any UK investors on the call, these are the figures. Obviously, you know, UK investors are paying a bit less in stamp duty and interest rates, so your returns are slightly higher there. But we can do the cash flows on any scenario for any unit for people at a later date. So the process is quite simple. So what we say is, it's quite important to try and lock in those interest rates. Holborn have got key referring mortgage companies that you can speak to, but it's quite important to lock in those interest rates now. And obviously a lot of the lenders are allowing you to switch as well. So you lock into a variable rate and you can switch when it gets to a better fix. For investment purposes, I'd say a 5-year fix at 5.49 is still very good when you're looking at those returns. So the reservation agreement is all done online. It's a platform called Your Keys. And basically for overseas investors, this is particularly interesting because you're not dealing with any kind of paperwork. It's basically an email that comes to you. You do your identity check, you complete the form, you pay the £1,000 reservation fee, and then the legals are done. You're introduced to your lawyer that way. The mortgage broker gets involved, and it's all sort of managed through this platform. So we're looking at about a period of, I would say, 8 to 10 weeks for completed product. So mortgages are taking around 6 weeks to get booked in, and you probably take around 2 weeks to get to that sort of offer stage. So so we're looking about that period of time from start to finish.
And that's
And
a very
by that point in time,
competitive,
Sorry, what's that?
competitive reservation fee there. I mean, we're used
Yes.
to 5,000, 2,500. That's good. And just to make it clear, I do this every week, that reservation fee does come back to you.
Yes, it comes off the exchange monies at the point when you put down 10%. And yeah, it's a very easy process. I think when you're dealing with off-plan property, things can happen a lot quicker, but obviously we need valuations to be done, you know, which obviously gives people that peace of mind as well, that they're fixing in now. So yeah, just to a little bit of a summary, and Pete might want to jump in on this as well, because he sort of touched on it quite importantly. The dynamic of the UK market is severe undersupply, and that's not really going away, is it, Pete? Is he still there?
Yeah, Pete's there, but he's muted.
Oh, he's
So we've got
muted.
lip read.
Not now. I'll just say, yeah, it's growing every day and every month. So that number's actually understated because they haven't factored in such things as people being born at a higher rate than people that are dying as well. Yeah,
exactly. So whilst the interest rates are slightly higher than they were, and they might sort of come down even slightly in the next few years, being in market is the most important thing now, and that's what JLL said in their report in December. Those that are in market in certain cities in the next 5 years are going to be, the most savvy investors and actually going to come out of this best off, because obviously you're still going to have a return, you're still seeing these increasing yields. And it is the safest asset class. So I think if you look at that graph, yeah, Pete's absolutely right. It's probably well off, actually. But going forward, if we look at where we were here, we had a little blip with COVID. It's not even going to be anywhere near that. We're going to come out of this. It's not even much of a downturn there. Global financial crisis fell off a cliff. We had a bit of a drop in the COVID times. We're not going to see much of that going forward, given the undersupply.
For those of you that are looking at building a portfolio as well, the pound cost average is your friend. The fact is, if you're looking to build, as quite a few people are, 3, 4, 5, 6 properties over a 5-year period, then it always works out. I was with a really good friend last night. He's the same as me, originally started off life as a joiner. He's got 8 properties. He's now got free flow cash of round about £10,500 a month from the properties he's bought, and they're all paid off. So Lovely. He's paid down all the mortgages, and he's got that on top of his full final pension salary as well. And this is the way to do it. Every investor needs to have a spread, but it's got to improve property. It's got to include property. It makes complete sense.
Yeah, it does. And I think when you're looking at some strong capital growth, and obviously, there's peaks and troughs in any market, but sort of coming out that back end with a completed product, when you're generating cash flow and you get to that 5-year period, you remortgage that property, you release equity, you buy another one. That's what the savvy investors do, isn't it?
Absolutely. I think that the rental yields are understated as well. I've got to say, looking at your numbers, I think over the next 3 years, you're going to see some really frothy increases in the rentals. So yeah, I think you're secure here. You've not overstated it at all, Lauren.
Yeah, it's a very central location, and that's what that report said, that sort of it's the city centre location. So that's what people want to be able to walk to work, right? I mean, and that's it is what it is. Just to summarise here, sort of this is just an example of, I've actually already showed you this slide. Warren Buffett on investment. He's obviously one of the greatest. Investors are the ones that are in market now and looking to get into the market now. So that's not what everybody can do. We can't all afford to do that. But as and when you can, you definitely should. So controlling what you can control now. Enter the market with a completed product. You know what you're getting. You know what you're paying. The currency is what it is. You're fixing those rates, and obviously you can enjoy some 5-year income as well as capital growth.
Thanks, Lauren. Can I put a quick advert in for Manchester's fantastic. It's a great story, but I just want to mention, Pete and I were in the chat yesterday, and we've obviously got other projects around the UK and in Berlin. But in particular, I wanted to have a quick chat with Pete and just bring to people's attention the Crowthorne story, which is very near Bracknell. Sorry, Lauren, if you think I'm taking it away, but just got to put an advert in.
Well, it's very relevant to what Lauren's offering us, because we launched a little project in Crowthorne in December, And I did actually say to everybody that listened in on that please don't hang around. This product's not gonna be here. And some people could say, oh, that's just sales talk. Well, absolutely not. There are 11 units. There's now 2 left. With this product here that Lauren's offering, it's not going to be around for long, because what interest rate are you going to get on your money and on your deposit accounts at the moment? You might, if you lucky, you might see 1.5%, potentially even 2%. That's your lot. You're not going to get any more than that. But what you're not getting on that, you're getting your 2%, but you're not getting capital growth. And I think that's the biggest single thing that people forget. Because if you've got, let's just say you've got 3% of capital growth that you're missing out on because you've got money sat in the bank, and you've got inflation, you're actually getting a minus number.
Yeah.
And this is really important to understand the dynamics of investing in property. It's not a get rich quick scheme, it's a get rich sensibly scheme. And Warren Buffett, the sage of Omaha, as he's known, I actually went on a lecture with him, and he tapped his microphone and said 1 billion, 2 billion, 3 billion, counting, when he was testing the microphone. He's quite a character. Now, one of his biggest investment is Coca-Cola. And the reason he's invested in Coca-Cola, because people are not going to stop drinking it.
Yeah, you're always going to need property. People always need somewhere to live.
Absolutely.
I mean, I've got to also mention, as well as Crowthorne, Birmingham, York, London, and other areas, as I mentioned, also Berlin. So if any of you out there, any of the clients out there, please reach out to your wealth manager. Wealth managers, we're here. All of us are here for client meetings, especially Lauren and myself. Always happy to get on a Zoom and go through these. This is being recorded and will be available on the website, which is holbornpropertyinvestments.com. I have to read it because we've changed it. holbornpropertyinvestments.com. So this and other leading world webinars are on there about all the projects we've had. So please jump on. Pete, anything else?
Only to say that, look, let's be positive about this year. I actually see that there's going to be a bit of an uptick. What's going to happen, in my opinion, if you looked at people that missed out on the change in the US dollar, there's only 1 or 2 people I know. Pablo was one who managed to chip out when it was 1.105 or something, and Mark McAllister is also he made sure that his clients chipped out at a very, very good rate and go to sterling. We're going to see some plays with the sterling, and so any of you that have got dollar incomes, this is still a great time to buy in. I personally think the pound dollar situation will go back to 132, 135. That's my view. So it's a great time still to dive in and take yourself a 8, 9, 10% uplift in the value that way by buying some UK stock. So and
a quick question came in from Zahi. Yes, completed. Absolutely fine on with regard to
we
mortgages.
do them every day.
In fact, must be easier, to be honest, because there are no variables. The price is the price. We've got so many comparisons. We're not talking about something that's 18 months off plan. So Zahi, no problem. Get out there and good luck to you.
Also, just to say that if any of you got the ambitions of building portfolios, do talk to Chris and I about that, because Lauren has got this product here. It's a great product to put on for one of your first investments, and then there'll be others coming up as well. So a blend is quite good. So buying physical stock, I think, is a great start to a portfolio.
It's worth also mentioning, by the way, following from what Pete said, and got so many expansion plans at Holborn Property, you won't believe it. We've obviously got Holborn Central, which is what we're doing here at residential. But if anybody out there is looking for commercial, for warehousing, for anything out of the ordinary, please don't hesitate. Send an email in, phone me up, and then we can see what we can do. Quick advert there again. Pete, what do you think?
No, thanks. I mean, something we're going to be bringing to the market very, very shortly, are small industrial units for SMEs. They're great for investors because they can tuck them in their SIP. And again, as many business people have said to me, why would I go paying somebody else's pension? I'd rather pay in my own pension pot. And that's what they're doing. You know, it's a great shame that they've changed things slightly with the residential properties, so that you can't have those in your SIPs. But I can't see them taking that back. Unfortunately, I'm old enough to remember when you could put them into pension plans. Unfortunately.
Yeah. Me too. But Lauren won't have a clue because she's from Australia.
She's too young.
She's from Australia and she can't say the word demand.
Absolutely.
Demand.
Well,
thank you, everybody.
Thank
As
you.
I said, the recording will be up there. Need anything, just shout out. You know who we are.